Alright, let's break down exactly what a margin account is. In simplest terms, it's like having a special line of credit from your brokerage firm that you can use to buy more stocks or other securities. With a margin account, you're essentially borrowing money from your broker to amplify your potential returns. By using borrowed funds, you can control a larger position in the market than you could with just your own cash. But remember, while margin can amplify gains, it also has the potential to magnify losses. So how does margin actually work in practice? Let's say you have $10,000 in your margin account and want to invest in a stock trading at $100 per share. With a typical margin account, you might be able to borrow up to 50% of the purchase price, effectively doubling your buying power. This means you could purchase $20,000 worth of stock, 200 shares, instead of the 100 shares you could afford with just your cash. Now, imagine if that stock price jumps to $150 per share. Your total investment would be worth $30,000, giving you a profit of $10,000. That's double the profit you would have made with just your initial $10,000. But the core principle remains the same. Margin amplifies both profits and losses. Before you rush off to open a margin account, there are a few important things to keep in mind. First and foremost, not everyone qualifies for margin trading. Brokerage firms typically have specific eligibility requirements, which may include a minimum account balance, trading experience, and a satisfactory credit history. You'll also want to carefully consider the margin interest rates charged by different brokers. These rates can vary significantly and will directly impact the cost of borrowing. Understanding these requirements and potential risks is essential before diving into the world of margin trading. Now, let's talk about why you might consider using a margin account in the first place. One of the most significant advantages is the ability to amplify your buying power. With margin, you can purchase a larger position in your favorite stocks or other investments than you could with just your cash on hand. If the stock price rises as you anticipate, your returns would be significantly greater than if you had only invested your own funds. Of course, it's crucial to remember that margin is a double-edged sword. While it can amplify gains, it can also magnify losses. Another compelling benefit of using a margin account is the potential to enhance your portfolio diversification. Diversification involves spreading your capital across different asset classes, industries, and geographical regions to reduce overall risk. With a margin account, you can free up a portion of your cash by using margin to fund a portion of your existing holdings. This newfound liquidity can then be strategically allocated to diversify your portfolio further. By strategically using margin to diversify, you can potentially reduce your portfolio's volatility and weather market fluctuations more effectively. Beyond amplified buying power and enhanced diversification, margin accounts offer the added advantage of increased financial flexibility. With a margin account, you have access to a readily available line of credit that can be tapped into for various financial needs, not just trading. Instead of liquidating a portion of your portfolio at a potentially inopportune time, you could utilize the margin feature of your account to access funds quickly and efficiently. This flexibility can be invaluable, allowing you to seize opportunities and navigate unforeseen circumstances without disrupting your long-term investment strategy. However, it's crucial to exercise caution and responsibility when utilizing margin for purposes beyond trading. Borrowing on margin comes with interest charges, and it's essential to have a clear repayment plan to manage your debt effectively. Alright, ready to unlock the power of margin? Setting up a margin account is usually a straightforward process, but choosing the right brokerage is a crucial first step. When comparing brokerages for margin trading, pay close attention to a few key factors. First, consider their margin interest rates. These can vary significantly from broker to broker and directly impact the cost of borrowing. Next, take a look at their margin requirements. Brokerages have different rules about the minimum account balance you need to maintain and the percentage of a trade you can finance with borrowed funds. Finally, don't overlook the overall trading platform, research tools, and customer support offered by each brokerage. Remember, investing involves risk, but choosing the right brokerage can provide a smoother and more informed trading experience. Once you've selected a brokerage that aligns with your needs, it's time to dive into the nitty-gritty of margin requirements and agreements. Brokerages are required to provide clear and transparent information about their margin policies. One of the first things you'll encounter is the margin agreement. This legally binding document outlines the terms and conditions of using margin, including interest rates, payment schedules, and potential consequences if you fail to meet margin calls. It's crucial to read this document carefully, understand your obligations, and ask your broker any questions you may have before proceeding. Next, familiarize yourself with the concept of initial margin and maintenance margin. Understanding these margin requirements is paramount to managing your risk and avoiding unpleasant surprises. Alright, you've chosen your brokerage, reviewed the margin agreement, and are ready to start putting your margin account to work. Funding your account is typically a straightforward process, similar to depositing funds into a regular brokerage account. Most brokerages offer various funding options such as electronic bank transfers, wire transfers, or checks. Once your funds are deposited and settled, you'll be able to initiate margin trades. Remember, margin accounts often have a minimum initial deposit requirement, so make sure you check your brokerage's specific terms. Now, before you dive headfirst into your first margin trade, it's essential to have a clear trading plan and risk management strategy in place. When you're ready to execute a trade, your brokerage's trading platform will typically have a designated section for margin trading. Now that you understand the ins and outs of setting up a margin account, let's explore some powerful strategies to make it work for you. One of the most common and effective ways to utilize margin is for leveraging long-term growth opportunities. Imagine you've identified a company with solid fundamentals, a strong track record, and promising growth prospects. By using margin to acquire a larger position in the stock, you can potentially amplify your returns as the company grows and its stock price appreciates. However, it's crucial to approach this strategy with a long-term mindset and a disciplined approach to risk management. Don't over-leverage yourself, and be prepared to hold your position through market fluctuations. While many investors associate margin accounts with buying stocks, they can also be utilized for short selling. Short selling involves borrowing shares and selling them in the market. If the price goes down, you can repurchase the shares at a lower price and pocket the difference. However, short selling carries higher risk than traditional investing. It's crucial to understand the mechanics and risks before attempting it. For investors seeking additional income, covered call writing can be compelling. It involves selling call options on stocks you own. You receive a premium upfront, enhancing returns. If the stock rises above the strike price, your upside potential is limited. Thumbs up and share if you find this valuable. Subscribe to CRAIGTRADER for more investing insights. Section 4. Maintaining a healthy margin ratio. As we've discussed throughout this video, margin trading can be a powerful tool for amplifying returns and enhancing your investment strategy. However, it's crucial to emphasize the importance of responsible margin management and maintaining a healthy margin ratio. Your margin ratio is a key metric that reflects the health of your margin account. It's calculated by dividing your account equity by the total market value of your securities. A higher margin ratio indicates a lower level of leverage and a greater cushion against potential losses. It's generally recommended to maintain a margin ratio that aligns with your risk tolerance and financial goals. A more conservative investor might aim for a higher margin ratio, such as 50% or more, while a more aggressive investor might be comfortable with a lower ratio. Regularly, monitoring your margin ratio and adjusting your positions as needed is crucial to avoid margin calls and minimize the risk of significant losses. Remember, responsible margin management is essential for long-term success in the markets. That's it for our deep dive into margin accounts and effective strategies for maximizing their potential. Section 1. Understanding margin calls. Margin accounts can boost returns but come with risks. The biggest risk is the dreaded margin call. If your account value dips below the maintenance margin, the brokerage will issue a margin call. You'll need to deposit more cash or securities quickly. Failing to meet a margin call can lead to liquidation of your holdings. Avoid margin calls by managing margin responsibly and setting stop-loss orders. Hit that thumbs up if this was helpful. Subscribe to CRAIGTRADER for more investing tips. Now, we've talked about how margin can magnify your gains, but it's equally important to remember that it can also magnify your losses. And that's where things can get tricky, especially when emotions come into play. Imagine this. You've got a margin account, you're feeling bullish, and you decide to leverage up to capitalize on a hot stock tip. But then, the market takes an unexpected turn, and your investment starts heading south fast. Suddenly, those amplified losses start to sting a whole lot more than they would have if you hadn't used margin. Fear and panic might set in, leading to impulsive decisions that can further erode your capital. That's why it's absolutely crucial to approach margin trading with a level head and a well-defined risk management strategy. Set realistic profit targets, establish stop-loss orders to limit potential losses, and never invest more than you can afford to lose. Remember, successful investing is a marathon, not a sprint. It's about making calculated decisions, managing risk effectively, and sticking to your long-term plan, even when the market throws curveballs your way. Stay tuned as we delve into more important considerations for margin accounts in the next section. Section 3. Interest charges and account costs. Now let's talk about the cost of using margin. It comes with a price tag: margin interest. Think of it like borrowing money from a bank. Factor in these interest charges when evaluating profitability. Some brokerages might also charge additional fees. Be mindful of interest charges and account costs. Section 1. Margin accounts, your path to financial freedom. So there you have it, folks. We've covered a lot of ground today, from the fundamentals of margin accounts to advanced strategies for maximizing their potential. Remember, margin trading can be a powerful tool for amplifying gains and accelerating your path to financial freedom. But like any powerful tool, it's essential to use it responsibly and with a clear understanding of the risks involved. Before you even consider diving into margin trading, take the time to educate yourself thoroughly, develop a solid trading plan, and establish strict risk management rules. Never invest more than you can afford to lose, and always be prepared for the unexpected twists and turns of the market. Remember, successful investing is a marathon, not a sprint. It's about making calculated decisions, managing risk effectively, and staying focused on your long-term goals. Don't forget to hit that thumbs up button if you found this information helpful. If you're ready to take control of your financial future and explore the exciting world of investing, the CRAIGTRADER community is here to support you every step of the way. Head over to CRAIGTRADER.com and sign up for our free newsletter for exclusive stock tips, market insights, and alerts delivered straight to your inbox. We'll provide you with the knowledge and resources you need to navigate the markets confidently and make informed decisions to grow your wealth. And don't forget to hit that notification bell so you never miss an update from the CRAIGTRADER channel. We're constantly adding new videos with actionable strategies, expert insights, and inspiring success stories to empower you on your investing journey. Remember, knowledge is power when it comes to building wealth and achieving your financial dreams. So, stay informed, stay engaged, and never stop learning. Happy investing.